Welcome to All About Stocks and Happy Diwali to you at home and your family. We hope the year to come is full of prosperity for you, which is why on this wonderful weekend we have Rashesh Shah, who's taken time out of his day to sit down with us and help us understand what's going on with our markets and how we can use this opportunity to make more money in the long term. Rashesh, thank you so much for spending time with us. Happy Diwali to you.
Yeah, well, thanks a lot, Faye. Happy Diwali to you and all the viewers out there.
Well, the last time we spoke was on another auspicious day. We spoke on New Year's, which is about 11 months ago now. And you talked about the fact that you are bullish on India's long-term story. You said that irrespective of what's happening in the short term, you believe that the Indian equity market will do well for retail investors who stick by it for the long term. Now, given what we've seen play out over the last 10 months, do you still believe in that long-term story?
Calendar year 13. There's been a key test of the faith in the Indian market. So if you think about it, I think we have gone through, a fairly bad phase, especially after May, when the fears for Fed tapering started. Then there was a rupee, crisis in that sense, and I think interest rates went up very sharply. Liquidity was crunched. Emerging markets went out of favor. Corporate earnings is slowing down. So almost everything bad that you can imagine about India has happened in the current year. And I think even after that, our equity markets are fairly stable. In fact, for the year they are slightly up as of now, but they are fairly stable. It just shows that there is a underlying robustness in the equity markets, and there are quite a few reasons for that. And as we go along, we can speak about that. But I think when you're buying equities in India, you are actually, especially if you're buying good companies with good management, good governance, good track record, you are actually buying a piece of corporate India for the future. And that I continue to believe, irrespective of what happens in the environment, will continue to do well.
But I want to bring you back to the fact that you said that they're slightly high. The market is slightly high at this point, and we saw it run up fairly smartly. You also believe that a lot of people right now are sitting on cash. What's causing this run up, and do you expect it to correct now in the near future?
I think, an 8-10% correction is always on the cards. I think that, slight change in liquidity, a couple of articles in the paper, a couple of shows on television can change the, 8-10% correction in the market. That I think is part and parcel of the markets as a whole. But I think structurally, we are seeing 3-4 things. One is we're seeing a lot of, polarization in the market. And then what we say the market, the index, is actually usually the large companies. And there is a scarcity of equity paper, of large companies which have good growth rate, good management, and all of that. But what we call the stock market, and I say that to say the top 250 companies which have good size, scale, track record, management team, governance. If you take all of that, and if you have those companies, I think some industries will do well, some will not do well. But on the whole, these companies will continue to do well, and having a piece of this company is a good thing for investors to have.
You've mentioned this in the past. When we talked in January, you also said investors need to look for these good companies and they have to rely on these good companies. They're not very cheap right now in terms of valuation. Is this the time then for us as investors to go out and look for these companies? Or would you say we should make a list at this point and then just go after them every time there's a dip in the market?
I think the second strategy is always slightly better. You need to be slightly counter-cyclical because you get that edge. Because as we know, market is about greed and fear. And as someone said, you should be greedy when everybody is fearful and fearful when everybody is greedy. But what you can also do is also buy good companies in what currently are slightly stressed industries. Like for example, private sector banks. I think in the last 3 months they have corrected a lot because of interest rate cycle and the liquidity crunch and all. But there are good quality banks available. They are not as expensive. The same thing is true with a lot of, like even IT industry. I think 3 months, 4 months ago is not very exorbitantly priced. Even now, IT sector is not hugely overvalued in that sense. So there are parts like maybe FMCG and some pharma is overvalued because for the last couple of years, a lot of investors found comfort in them. But there are always good quality companies in industries which are maybe struggling at that because industry cycles are a given.
Has enough changed on the ground for us to be optimistic? We're still very dependent on foreign money. We haven't seen any of the deficits that the government was worried about. We haven't seen them drastically come down. That's still something that we're battling. Inflation is something we're battling. The interest rates are still very high. Is there reason then for us as investors to be optimistic? Do you think that the volatility will ease out now, or is there more to come?
I think I completely agree with you. I don't think there is reason for optimism. I think there is reason for absence of the pessimism that was there in August. Because in August, we saw extreme pessimism about India, about currency, about everything else. I think that has gone away, and that should go away because of a lot of things have happened in the last 8 weeks. But I don't think, and in fact, investors should never enter the market when everything is very optimistic, because that is usually, as I said, you want to be counter-cyclical, not very pro-cyclical. I don't think the market is at a stage where you should go and put all your investments at the same time. And hence, as we were chatting earlier, I think a systematic way of investing, so that you invest across cycles, is usually a good strategy for a retail investor. But currently, I think corporate earnings is still slowing down. I think there is elections around about a year from now. The quantitative easing tapering is not gone away, it's just been postponed. So there are clouds on the horizon, and people should be cognizant of that. But equity investing is about risks, so there will always be risks. But in this, whenever you get a chance to buy good companies at say reasonable value, you should not shy away from it.
We also, when we spoke in January, you talked about the fact that a lot depends on reform this year. A lot depends on whether the GST they actually managed to bring it in. You expected 1 or 2% higher on the GDP if GST is brought in. Most of the year has gone by so far. Have we seen enough happen in terms of reform? We haven't seen GST, but in terms of reform, have you seen enough happen? And how much now hinges on the 2014 elections?
I think behind the scenes, there is a lot of executive-related stuff that the government has acted upon. What is in their power, what the government can do on their own without having to go to the parliament. Where the reforms have got stuck is when they need to go to the parliament. The government has truly acted, and I think there is a sense of we need to do it now, we need to get it done. And when we interact with the government officials also, we are sensing after March that there is a strong feeling that we cannot drag our feet. So whatever the government is able to do, I think they are committed to doing it.
Rashesh, before we went into break, we were talking about the fact that you said the government has done some things right. Now, earlier, the last time we spoke, you told us to beware of policy volatility moved by the government that can impact the business that we've invested into. Is that still a risk that we should worry about as investors? Should we make it a point to steer clear of any business that has policy volatility right now?
Governments very often, in their eagerness to act and do something, they add to a lot more volatility. They want to very often they want to help, or they want to clean up, or they want to change stuff. But usually it comes at a fairly bad time for the industry, because you're already grappling with the change in the external world, and then you also have to grapple with the change in the regulatory world. It happened in the insurance industry in India. It happened with mutual funds in India. So I think in a way, and it's happening all over the world, that governments need to, the government and the regulators, they need to enforce change, they need to clean up stuff, and there is always a lot more to be done. But I think calibrating it, trying to time it so that it's not, constantly people are adapting to the regulatory environment changes, as well as, the entire business cycle. Like for example, currently investment climate is bad. So anything you do which makes it worse is actually pro-cyclical in that sense. The government regulators should be more counter-cyclical rather than pro-cyclical.
Well, as an investor, if I'm looking at the range of stocks available to me in the market right now, I could find government policy in almost every sector. Now, to what extent is it comfortable to have government interference or government policy impacting my stock? And at what point does it, should I not invest in that stock at all? How do I make that decision?
I think in the current environment, people are shying away from anything that has any regulatory impact. If your business or your industry is impacted by any and there are actually 3 categories of businesses if you see broadly in India. There is a category which is primarily dependent on government, where approvals and all of that, like infrastructure and power and all are classic ones, where your coal comes with a government approval, all of that. So infra is very primarily government oriented, and that's why investors are shying away from that. there is certain industry which gets influenced by the macro rules and regulations formed by the government, but it's not that you go into government for approvals and all. Like, for example, banking and others, they get impacted. Some amount of the manufacturing gets impacted by that, which is investors are actually willing to invest in good companies and that who can handle the regulatory changes. But usually these companies adapt to it because they don't have to go for approval for government. And the third is industries which are fairly immune to government, government involvement from even the environment point of view, like FMCG or pharmaceuticals or IT services or even a lot of the consumer-oriented companies. Currently, investors are favoring those a lot more because they are safer from the volatility point of view. There is an industry volatility that will be there. FMCG industry will go through up and down. That investors feel capable because then you can make a call on the management. In fact, on the other two, even if you make a call on the management, but the government either they stop giving clearances or the approvals are slow to come, that does increase the execution risk a lot more. So I think there are three categories. Investors are shying away from the first category for sure because of what has happened in the past.
And like you said, if we pick the good companies out of the other two categories, we should be okay.
Yes, and to answer your earlier question, the third category, which is completely largely immune to government, government involvement, are fairly priced because investors have already taken shelter in those. I think it's the second one where there is still some amount of room left, where you can, it's an industry cycle, and the industry will come back because for coming back they only need the environment to change, not the government approval process for that.
But since we're talking about volatility, it's been a very interesting, let's say the last quarter, where we saw volatility in our bond market, we saw volatility in gold, and we saw volatility in equity. Right now, as a retail investor, when I'm looking at all of these asset classes, there is a tendency to pull all of my money out and put it in a fixed deposit because that's what seems safest at this point, and the rate's not bad either, let's be honest. What is the argument right now to stay in equity? Because the question we are asking is, over the last 5 years, where has the market gone? We've seen enough volatility in the other two asset classes as well. Why should we spread our money across these asset classes?
And given the way things are, you should have a part of your portfolio in fixed deposit. Interest rates are good, are high enough. But you have to ask yourself, will it allow you to keep up with inflation? Because on an after-tax basis, it still maybe just about keeps up with inflation, the purchasing power of that. So I think the argument for equity has always been that it should be part of a portfolio, part of your asset allocation in that sense. But I think, whatever the age profile and the risk profile that you have, some amount in equities will always be a long-term growth and a long-term hedge against inflation, because on an after-tax basis, it will still do well. It has done well, and even in the last 5 years, though you might say the market has not gone anywhere from a point-to-point basis, if you were investing every month or ideally every week or in those 5 years, I think you would still have got a fairly okay return up till now.
So the other question I have for you as far as investing in equity is, when we're talking about a retail investor who doesn't maybe have the time or the wherewithal to do the massive amounts of research that it takes, so to constantly track a stock and the management and the results, does it make sense then for me to just buy the index or use an index fund perhaps? Is that an easier way to approach equity?
It's an easier way, or you can also invest into mutual funds. And I think, fortunately in India, we have so many mutual funds which have great track record, great fund managers, and the asset management cost is not very high. And the outperformance actually overcomes the handicap of the asset management cost. And you have fairly good track record that is now available to investors. So I think going through mutual funds or buying an index or buying an ETF on index and all this, the investor has a lot of options depending on what he or she wants to do. If she wants to be involved and do stock picking, that option is also available. Good quality research has now got fairly democratized, and that is also available, but you may not have the time and the wherewithal for that. If you want to go through mutual funds, you want to go through index, I think all these options are available, and people have to choose what they are the most comfortable with.
I have to ask you about gold on behalf of all of our female viewers who are possibly at this point urging their husbands to go shopping. Does it make sense right now to add more gold to our portfolios? We saw a little bit of volatility, but in the long term, do you believe gold is a stable asset?
Well, I would say, first of all, if your husband is buying your gold, encourage him to buy more and more, because actually I do believe gold as a consumption if you enjoy it, you should do that, because you should not confuse the investment part and the consumption part of gold. And I think, as I have seen, a lot of people enjoy, wearing gold and having that part of that. So that is, I think, as an investment, I don't think it is a good time right now to really load up on gold. You might have some part of that for any future need, or you have a kid who's going to get married and stuff like that. But on the whole, I think gold has corrected quite a bit from the peak. But at the same time, we're seeing consumption of gold, I think, steady down. And one thing you should see, when real interest rates are positive, like currently all over the world, interest rates have gone up and inflation has not gone up. So whenever real interest rates are positive, usually hard assets don't do well. They do very well when real interest rates are either zero or negative, which was the case a year ago. So if you see, there is a high correlation of gold, how gold or any other hard asset will perform vis-a-vis real interest rates. So I think that scenario has changed. So our thing is, have it as a small part of your portfolio if you have that, but it is not a good time to be overweight on gold.
So the other thing I wanted to ask you about was our bond markets, and we know that one of the options to a retail investor who's looking for a short-term, perhaps debt investment where his money is secure, is a debt fund or a fixed maturity plan, which are both debt funds. And the other option is to either use a recurring deposit or a fixed deposit. Now, do you believe that there will continue to be volatility in our bond markets? So should we stay away from those short-term debt funds that saw all of that volatility maybe a few months ago?
I think it's unlikely that we will see what we saw a couple of months ago, because I think that was extreme. When 300 basis point increase in rates over a week is very unusual. I don't think it's happened for many years. I also personally believe it was too harsh a shock to the system. We had other instruments available without shocking the system in that way. But it's happened. It's done. But I think overall, FMPs and all, they don't have the mark-to-market issues and all, may give investors good, returns. So I think over the next year, we're also advising a lot of investors to be invested on the short end of the bond market, which is about a year. Keep your money liquid and just stay, because there will be a lot of opportunities that will come about. So on the whole, I think as we are bullish on equities, we are equally, I think it depends on how you do your asset allocation. I think there is a part for the short-term bonds.
Well, a lot of the viewers who write into us have all of their money in their bank accounts, in their savings bank accounts, and they haven't started at all. And they normally get worried saying, is this the time to start? Am I already too late to get into any of these asset classes? It's normally, it's something that makes people nervous, especially our female viewers get nervous with all of the numbers that get thrown at them, and they just want to stay away from all of it. For someone who hasn't started up till now at all, what's your advice?
See, on the whole, I do believe that I think risk is an existential reality. By just keeping money in the bank, you are still taking risk, because inflation is eroding the value of the purchasing power of that money. So I think you should first get comfortable taking a little bit of risk. What you can afford, if it is worth it, and I think equity investing is a risk that is worth it, it's subject to you can afford it. So you should decide what you can afford, and it's not that you can afford to lose the money. You can afford the volatility of returns. So if you have, say, 10 lakh portfolio, and you say, okay, 8 lakhs out of that, I want a consistent return every year, because I want to see that gives me comfort, or I have the need for that cash. 2 lakhs, I can take the volatility of return. I know over long term it will give me X amount of return, but I don't need to see that return every. So decide whether it's 2 lakhs, 1 lakh, 50,000, and then start with that. Get used to market, follow the good habits, good principles. And as I said, ideally stay emotionally calm, don't get swayed by it. And say that you are in for the long term, and if you have to make mistakes, make it when your amounts are very small, so that you can learn from that fairly quickly.
Right, we're running out of time, but before we go, I'm going to be, in an unembarrassed sort of way, I'm going to ask you for a Diwali gift on behalf of all of our viewers. Is there any more advice you could give a long-term retail investor who's watching at home this Diwali?
I think again, we have a lot of companies where there is a great track record available, companies that have been compounded growth at 18, 20, 25% over the years. They have good return on equity, good earnings, good quality management and governance. There are a lot of these companies. A lot of them are still not very expensive. They are trading at maybe 14, 15 to 18, 20 P multiples. And I think it's always a good time to try and buy that and hold them for the long term. Even I think the recent correction in the banks, especially the private sector banks, is a very good opportunity for investors who have been underinvested in banks to buy them. Because on a long-term basis, I do believe that private sector banks in India, a lot of them will do well because there is secular growth available for that.
All right, Rashesh, thank you so much for spending time with us. It has been an absolute pleasure to spend time with you. Happy Diwali to you and your team and your entire family.
Yeah, Faith, thanks a lot. Happy Diwali to you and everybody else.